welcome to our special coverage of the heightened pressures on the global financial system and the banking breakdown. I'm Francine Lacqua here in London. Now, more turmoil in the financial world this week with Credit Suisse front and center. We'll unpack the broader pressures in the banking system and what lies ahead in terms of regulation and consolidation. Now, the storm swirling around Credit Suisse dates back years. In March 2021, the lender was hit by a double dose of bad news following the collapse of Greensill Capital and then Archegos, which left Credit Suisse holding the bag on billions of dollars of losses. Now, the Zurich-based bank has also been rocked by legal trouble and instability in the executive suite, with 3 chief executives and multiple chairmen since 2020. Some investors have had enough. Harris Associates, of course, the biggest shareholder in the bank, last month saying it has sold its remaining stake, ending about 2 decades of ownership. Now, the question now is, what will it take for Credit Suisse to break down the downward spiral after this injection of capital and, of course, the regulators stepping in? Bloomberg has spoken to current and former Credit Suisse executives about the bank's performance over the past few years.
It's too premature to make a prediction now for 2021.
It's clear that 2022 will be at lower levels than last year.
Thomas and I came to the conclusion that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire.
We want to go through the transformation of the next 3 years. It will become profitable definitely from 2024 onwards.
When you are where we are, with the historically low on the share price, with a great management team, with a plan that is convincing the market, and the market, our shareholders believe it.
The results are unacceptable, obviously. We said we are going to make a loss, unfortunately, this year. A lot of the restructuring costs, baked into the transformation are coming in 2023, before we see a lot of benefits.
In a moment, our expert panel, but first, Bloomberg's Oliver Kirk, who's in Zurich. Ollie, the SNB has provided a lifeline to Credit Suisse. What options does it leave going forward?
That's right, and you picked the picture there, Francine. So a bank in trouble into a bank in crisis this week, SMB trying to stem the flow, and so much has returned some stability and calm to this market in the short term. The question is, how long will it last? That will come down to clients. Will clients stick around? Will counterparties stick around? Will staff stick around? And at the end of the day, the market will be the dictator in this. It's what has triggered this entire crisis. And a lot of analysts out there are skeptical that Credit Suisse can keep going as a bank as it is formed today. There is, of course, behind me, Credit Suisse. They're looming in the distance. You see UBS, JP Morgan's base case or most likely outcome is a takeover. But the second you start looking at what that actually looks like, some of the logic falls apart. UBS is trying to push into the United States. Credit Suisse does not offer them a lot there. There's a lot of client overlap. They do not necessarily have the same risk appetite. UBS, according to our reporting, may not want the same kind of risky clients that Credit Suisse has. And then there's another question of overlap, antitrust, and also the Swiss government. This will cost jobs potentially. And then the last question for me is, how much has UBS already benefited from the fallout of this week? How much of client flow and migration will there be? And that's a question that I think we'll get the answer to over the next couple of weeks.
Ollie, thank you so much. Ollie Crook there, setting the scene. So to our expert panel, we have, of course, our global team across Bloomberg that's been keeping an eye, a very close eye. That's been breaking news, actually, on Credit Suisse and other European banking system and banking stories. Joining us now, Bloomberg's Marion Haltefmeyer, who's been on top of the story from the very beginning. Jan-Henrik Forster from our M&A team, and Bloomberg's opinion global banking columnist Paul Davies. So thank you all for joining us. Marion, let's start off with you. When you look at the chief executive and the team right now, is the only strategy that they can do is stick to what they have said, the 3-year plan, and hope that clients and deposits stick around?
There is a lot of hope, yes. I think the signs that we're getting and the public messages that we're getting from the executive team is, we have our plan, we're sticking to it. And, now that we've resolved the liquidity questions and the market panic, at least in their view, this gives them a bit of breathing room to actually continue on their plans and accelerate their plans as and where is possible. That being said, you asked them a couple of days ago whether the shareholders and investors are going to have patience for that. And it's looking like that buffer zone of patience is increasingly decreasing.
Yeah, Jan-Henrik, how involved at this point is the government in trying to find a solution? The government, but also regulators. They can't force anyone to break up. But is this ultimately the only thing that the bank can do?
That is true. They can't force UBS to buy all the free float of Credit Suisse. That's impossible. I mean, I can tell you what we know, and that's really not much. All options are being considered by the government, i.e. the Swiss National Bank, FINMA, and also the finance ministry, right? One option is obviously you try to ask UBS, can you buy this and fix the problem? Or you find, under Swiss TBTF regime, you find a solution for the Swiss business. We understand that both banks are against any forced measures here. And that's really the status quo. So we probably will learn more over the weekend. I guess the liquidity line bought time. And I think the market also knows it's very difficult to bet against the Swiss National Bank, right?
Yeah, certainly. If they're the ultimate backstop, a lot of people maybe won't take them on. When you look, Paul, first of all, congratulations on all of your columns. There's something that stuck, I think you wrote that 2 days ago, saying, look, at this point, it's faith, not fundamentals on Credit Suisse. Like, how do you see this playing out? What options do they really have?
Well, I think, the acute phase is past now, in the sense of, a sort of a real feeling of imminent crisis due to the kind of the liquidity that's been added. And where we are now is back to the kind of the problems of, the longer term profitability issues, how they restructure this bank, what it looks like going forward, and getting, investors particularly in the stock market, but also in the debt markets as well, to understand the story and be able to kind of, price it and model it properly so that they can, make a proper decision about, where and whether to buy the shares and the bonds and so on. And that's really crucial for stabilizing the business and putting a floor under the stock and bond prices.
Marianne, any insight into actually what happens over the weekend? I mean, I'm sure that there'll be open channel of communications between the regulators, the policymakers, and everything like that. But is it a timeline? Is it a very short timeline in terms of trying to shore up this bank even more, or could it take months?
That's really unclear, Francine. I think what we're going to see in the next 48 hours and over the weekend into next week is the executives are certainly going to be working full speed on figuring out what not specifically the lifeline gives them, but more prominently, how the panic of this week has affected their business. So, you'll remember back in the fall when there was a lot of panic and questions around the solidity of the bank and their ability to restructure, there was a resulting 110 billion of outflows from wealthy clients. So we'll have to see whether some kind of reaction like that has happened this time around again, and what that means for their business going forward. Talking to people on the ground and in the bank, it's frustrating. They've had to deal with a lot of this bad news, and that makes talking to clients very difficult. And so whether or not that means business they might have lined up and now has vanished can come back or not.
Yeah, it's very difficult, I guess, if they can only stick to the strategy, try to keep staff, try to keep clients. Paul, one of the other, if you're a depositor and you have so many options, even if you're not worried about liquidity, even if there's not a fundamental problem, why would they stick with the bank?
That's a very good question. I mean, I think that, some of the assets and deposits that people will have with the bank, you can't just take out straight away. You'll have time deposits, you'll have collateral for, other trades that you are doing as a wealth client and so on and so forth. So, there's some natural breaks on this. And I think one of the things that they said in terms of their, how net assets were moving now is like, the flows have stabilized a hell of a lot. And I think they're probably seeing still some, deposits that are time deposits that are maturing, roll off and the money not coming back. But, yeah, it's a tricky decision, I guess, to take at the moment if you're a client.
Yeah, and if you're a regulator, so even if you're maybe looking at all options and trying to, if not push, coerce, the two big banks, Jan-Henrik, to come in place, I mean, this has huge systemic issues. Does the regulator even want a super Swiss bank?
Well, if we look back, basically at the regulations since the financial crisis, it was all about we don't want banks with too big of a balance sheet. Then the second point is really Switzerland wants two global banks, right? And also think about kind of the cultural issues here, right? Credit Suisse and UBS have been arch rivals. They don't want to merge. They didn't want to merge. And I think that's something you have to consider in this context as well.
But Marianne, and maybe to Jan-Henrik as well, I mean, does this touch the reputation of, the Swiss banking system that for many years was held in high regard?
It does, and I think that across the banking industry here, it is having an effect. I mean, rival wealth bankers are also having to explain the situation in Switzerland to their clients. I mean, it has put a little bit of not a full stigma, but a little bit of questions around Swiss banking, and it doesn't look great. Obviously, the Swiss regulator is trying to show a force and saying, we know how to handle our banks. Look, we have this liquidity line. We are talking with Credit Suisse. We are talking with UBS. But it does cause a little bit of a question of, how stable is Swiss banking in the future going forward. As Jan-Henrik said, they're a very important banking country, and they like to have their two Swiss national champions.
Yeah, and at the same time, it also, of course, raises questions about Michael Klein's boutique, Credit Suisse First Boston. Paul, what did you learn this week in terms of the banking system? I mean, this was, I guess, fear out there. Could it happen? And we know that Credit Suisse has had huge problems, but are you worried that it could happen elsewhere?
Do you mean in other European countries, or
in another bank?
Yeah, I mean, I guess we're living in these quite sort of, tense times. It's probably more in the US than in Europe, but we've obviously had, an awful lot of quantitative tightening underway, money sort of leaving the system. And I guess, what we're seeing in the US is a problem not necessarily of not enough money, but just money not being in the right places. It's a kind of a distribution issue. And, perhaps, maybe you could start seeing some of that in Europe elsewhere, but I don't think, it doesn't seem to be on the cards. I mean, it seems to be still, there's a lot of liquidity around, and we're not seeing, I don't think, yet anything like the same sort of issues of, sort of deposits drifting from some of the smaller banks to some of the larger banks.
Yeah, I wonder whether it does mean that anchor investors, large investors, shareholders will maybe speak a little bit less, given what happened with Saudi Royal Bank this week. Thank you very much to our wonderful Bloomberg team panel. And of course, they're the people that have been breaking the most news on this story. Bloomberg's Marian Halftermeyer, Jan-Henrik Forster, and Bloomberg Opinion's Paul Davies. Coming up, the banking crisis spreads. We'll speak to the NatWest Chairman, Howard Davies, about the resiliency of the European banking sector. That interview is up next, and this is Bloomberg.
They say that all press is positive. That isn't the case for Credit Suisse, which has had more than its share of bad headlines. In March 2019, it emerged that Credit Suisse had hired private investigators to spy on a former employee it suspected of taking its clients.
Our shareholders have been extremely robust. If you look at the share price, it's not the share price of a company in crisis.
The collapse of supply chain financing company Greensill Capital embroiled the bank. Swiss regulator FINMA said Credit Suisse had made, quote, partly false and overly positive statements when it marketed $10 billion of funds to clients as safe investments.
I'm actually confident that we will come out stronger.
Soon after came Archegos Capital Management. Its collapse brought Credit Suisse $5 billion of losses and saw executives fired. It also found itself the first Swiss bank to receive a criminal conviction tied to a cocaine smuggler. Efforts to reassure investors ran into problems.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That saw FINMA open another investigation when the bank reported those outflows had continued. After the collapse of Silicon Valley Bank, investors are now eyeing others for signs of weakness. With Credit Suisse, they're not liking what they see.
A look there at some of the problems Credit Suisse has run into the recent years. Now, the crisis at Credit Suisse is raising questions about the state of the European banking sector. Joining us now is NatWest Chairman Sir Howard Davies. Sir Howard, thank you so much for joining us. When you look at the concern of the banks that started in the US is now infecting, of course, Swiss banking, are you confident that there's no systemic risk, that actually whatever happens, that the financial system is strong enough to withhold it?
I am pretty confident, and I think the reason for that is if you look at the differences between what's happened with some US banks, not all, of course, and what's typically the case in Europe, you see some things that are the same, but some things are very different. The one thing that's the same, of course, is that we've all dealt with a long period of very low interest rates, followed by, or accompanied by quantitative easing, and therefore a lot of cash swishing around the system, and then followed by a gradual tightening, or quite a rapid tightening of interest rates, and that's caused some grinding of gears in the financial system. But the difference is, so that's been the same in Europe as well as in the US. The difference is that in the US, in many cases, banks seem to have invested in bonds. Loan growth was relatively robust in the US. And then what started to happen is deposits began to flow out of the banking system into money market funds and elsewhere. In Europe, we've had very low loan growth, actually. People have typically put their money in cash, not in bonds. And we haven't had the scale of deposit outflows that they've had in the United States. So European banks are typically very liquid, sitting on a lot of cash and not sitting on potential losses of holdings of long-term bonds, which is apparently what has caused the problem for SVP. So the situation is really generally very different in Europe from the United States.
But Sir Howard, so how do you explain the Credit Suisse crisis and the fact that it has impacted all European banking stocks?
Well, I don't want to comment on the specifics of Credit Suisse. I mean, there is honor among bankers as well as among thieves. Obviously, Credit Suisse has had idiosyncratic issues, and I don't think people could sensibly read across from that one particular bank to the rest of the banking sector. So what I can tell you is overall, the European banking sector remains strongly capitalized, and it remains very liquid. And we have not seen the kind of deposit flights that is causing problems in the US. We've seen some shift from non-interest-bearing deposits to interest-bearing deposits, but typically within the banking system. So that, reduces your net interest margin a little bit, but it doesn't cause a liquidity issue.
Does it mean, though, that regulation could change even in the UK, and that if Europe is actually better protected in terms of capital, which you've explained very, very sensibly, how do these crises, though, change the European banking landscape and the UK one in coming months and years?
Well, I think it would be a false analogy to say that because of regulatory difficulties in the United States, we should tighten over here. The big thing in the United States seems to be that they exempted smaller banks from some of the regulatory requirements, notably from stress testing. That, I believe, was an error. Many people said so at the time. Over here, we have a very rigorous stress testing regimes whereby we're required to model the impact on our bank balance sheet of a significant rise in interest rates, for example, which would expose the issue that seems to have done for SVP. So I don't see why we need to change that. We need to carry on doing what we've been doing. There are in Europe as well, or the UK anyway, some increases in capital in the pipeline as a result of Basel 3.1, as we call it in the jargon. And so I think perhaps that will go ahead. But I honestly don't see that this causes us to think that we need a major review of the European banking regulatory scene, where banks are still pretty strongly capitalized. We have about 14% core tier one, and we've passed our stress tests well. So I don't honestly see what it is that about this crisis that would tell us I need NatWest, a different regulatory regime.
Given the speed at which central banks actually stepped in with offering either credit lines or guaranteeing deposits, is there an assumption that actually central banks will always be a backstop?
Well, some of us are a little bit nervous about the blanket deposit guarantee. I mean, this has caused now significant unlevel playing field because, in the US, they had $250,000 guaranteed. Canada, it's $73,000 guaranteed. And in the UK, it's £100,000. And typically, that's the rate in the rest of Europe. So now there is a major asymmetry with apparently US guarantees across the whole banking system, which most people would say, and certainly I would have said when I was a regulator, was generally a bad message because it removes market discipline for very large depositors. So personally, I'm not really very happy about that as a general principle, and I very much hope that we don't have to go that way in Europe.
Do you think we'll have to go that way in the UK? And of course, what you're talking about is a moral hazard. What's the longer-term effect of a possible moral hazard?
Well, I don't see that in the UK. I think it would be a panicky reaction for which I don't see a justification at this point. As I've said, we haven't seen large-scale deposit outflows from the banking system because people have had confidence in the liquidity regime, and we disclose our liquidity rates regularly, and in the capital regime, and in the stress testing regime, and of course also ultimately in the recovery and resolution regime if things get really bad. So I don't quite see why we would need to alter that regime at the moment. Now, all bets are off sometimes. You have to recognize that sometimes the situation overwhelms you and some of the principles you have to be temporarily mislaid. But at the moment, I don't think we're there.
Sir Howard, I know you worried about shadow banking when interest rates go from 1% to 5%. Is that still your main concern? And is there anything that central banks could do, slowing interest rate hikes, or regulators need to look at?
Well, I'm a bit nervous about the change in interest rate policy because, after all, the central banks are supposed primarily to do to deliver interest rates which will be compatible with their inflation target. And I think once you get to a position where the central banks say, well, we've kind of suspended our inflation target because we're worried about the small bank in California, I don't think that sends a particularly good message. That's likely to create more uncertainty and nervousness overall. So I'm not keen on the implications being seen to overturn monetary policy principles. I don't think that's a good way to go, actually.
Thank you so much for your time today. Sir Howard Davies there, the chairman of NatWest Banking Group. Now, the events of the past week have certainly given rise to some longer-lasting questions about the future of the banking sector on both sides of the Atlantic. For more, let's also bring in Bloomberg's managing editor for EMEA Finance, Michael Moore. Mike, I know your team has been working relentlessly on scoops, trying to get the first opinions out. What happens, longer term? What happens in the next week and the longer term? What are some of the big questions that investors should be asking themselves now?
Yeah, I think you can approach this from the investor perspective and the regulator one. Howard Davies talked there about you might see the regulatory system that's already in place being expanded to more banks and smaller banks. The assumption for a long time was these small banks, if they went down, it wouldn't have that much of an impact. But we've seen, in the U.S. with Silicon Valley Bank, we've seen here in Europe with Monte dei Paschi, these banks, while they're not globally systemic, they might have a particular importance in one region or one industry. So I think you might see more regulation of those smaller firms.
Yeah, and of course, Credit Suisse, also the concern was that it was so embedded. Now, this all started on Thursday morning after we spoke to the Saudi National Bank chairman, and this is what he told Youssef Gameldin about raising capital.
Absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
This was actually on Wednesday, and then he spoke to another media on Thursday saying, look, the panic was completely unwarranted. How did you live through this? Was this panic, fear that led to this, or was it the shareholder misspeaking?
I think it was jittery markets. I think, there was a lot of uncertainty. I don't know that many people expected the Saudi National Bank to take a 25% stake. It removed one possibility of a quick capital raise, but I think it showed just how much concern was out there, because this is something they had said when they took the stake was, we want to keep this below 10%. So I think it was Credit Suisse, faced this in October as well. There was some concern and it escalated quickly.
Michael Moore, thank you so much. As always, Bloomberg's managing editor for EMEA Finance, Michael Moore. That's it for our special coverage. We continue to bring you all the developments over the weeks ahead and what it means for the health of the global financial system. This is Bloomberg.